And this is why investing is so different, and you want different things depending on your situation. If I'm 35 years old and I'm in my peak savings years and I have durable income, I want the market to go down before it goes up.
To show, but before I get into it, welcome to the Money Alchemist.
Oh, you're ready
podcast.
to go.
I'm ready to go, man. Let's
all right, well,
welcome everybody to the show. Episode 60.
Jeez. All right. Well,
it's the 4th of July episode.
4th of July.
It'll come out on 4th of July, I think, right? Isn't 4th of July on Saturday?
Happy birthday to America.
250th.
Isn't it?
Bicentennial.
You know, I've watched a lot of, like, Netflix has all of these for the 250th anniversary of America or whatever, the Netflix has pushed out all these historical shows. I've been watching the heck out of these things. I feel like I know more about the Revolutionary War and like some of the key players in that I ever have before.
Yeah.
It's kind of wild.
Well,
Life was crazy back then.
Oh, yeah.
You know the story of Daniel Boone? Have you ever actually heard this guy's story?
Daniel Boone was he was kind of a jerk. He was a terrible husband.
Really?
So, yeah, well, listen to this.
I didn't hear that part of the story.
Yeah, all right. So Daniel Boone settles in, I think it was Virginia, right? Is that where he settled? Is Virginia. He has kids with his wife, and then he's like, you know what? I got an itch. I got to travel. So he just like bails, goes into Kentucky, and he's like, this place is amazing. I love Kentucky. And he comes back and he gets his brother-in-law. He's like, come on, come see Kentucky. Takes his brother-in-law to Kentucky, gets him killed. His brother-in-law gets captured.
You watched a different documentary than I did.
No, I read this about Daniel Boone. But anyway, yeah, so look, read about it. Daniel Boone, goes to Kentucky, thinks it's amazing. Kentucky is amazing. It's like Appalachia. You know, you go to, what's that place everybody
Cumberland.
goes? Well, Cumberland, but it's, anybody who hasn't been to the Appalachian Mountains in Kentucky, it is just beautiful. So I totally get the appeal and the draw to it. But he goes to Kentucky, travels around, pals around with the natives, loves his time, gets his brother-in-law, brings him out. And by the way, they have wives and kids back home. Think about that. Imagine if you just were like, sorry, Meg, I'm going to go see South America for about 6 months to a year. I don't know when I'm going to be back. And then you just bail.
Yeah, these days, if you can't get a hold of me on a cell phone, it's like you might be dead on the side of the road or something.
Yeah, I don't know what Daniel Boone's brother-in-law's name was, but let's just say it was Jimmy.
How did we ever live a life where we couldn't get in touch with each other 24/7? I mean,
I remember this. I remember I drove across country. I used to go to school in California, and I drove across country with one of those iWireless phones, which was pay by the minute. And by the way, these things had terrible reception. Almost none of the way.
Especially when you're driving through South Dakota.
Yeah, no reception at all. And they called them the brick, these phones. And I had nothing but an Atlas. I literally had just an Atlas. And it was so stressful in downtown LA trying to navigate things. You actually had to read the road signs. Today, nobody reads the road signs. You just kind of just listen to your GPS. But yeah, I remember that. Yeah, I don't know if you do.
And Daniel Boone didn't even have an atlas.
Daniel Boone didn't have that.
He just kind of tracked through the woods.
Yeah, well, they used a compass. I imagine he had something like that or just a sundial. But the story of Daniel Boone's
I guess the
wild.
reason why I brought it all together is it is pretty incredible, all of the things that had to go right and fall into place for our country to come together. Just to cap the story of Daniel Boone, and I'm sure I'm misquoting this a little bit, but my understanding is he was captured by the Indians, and then the Indians wanted to bring him back, or the Native Americans, I'm sorry, wanted to bring them back, wanted him to negotiate a peace deal with Boonesboro, his settlement that he created in Kentucky. So the Native Americans are leading Daniel Boone back to Boonesboro so that he can convince the Boonesboro people just to lay down and be done. He ends up escaping the Native Americans and barefoot goes 100 and some miles through the jungle, through the woods, to beat the Native Americans back to Boonesboro, warn all the people about the Native Americans coming, and then they survived an 11-day barrage of basically getting raided and arrows shot at. I mean, it was as bad as the way that the documentary framed it, and I didn't double check or fact check this, but it was the Native Americans actually realized their attacks weren't working, And so they decided to take a different play. They hung out in the woods. They got a bunch of bow and arrows and lit the arrows on fire and shot fire arrows into Boonesboro and lit the whole thing on fire. And a storm ends up showing up and puts the whole thing out.
Yeah.
I mean, it almost sounds like a myth when you say that, but it's just, I'm sure, whether that happened or not, I mean, it's like all of the things that had to go right to lead to the America we have today is pretty incredible.
Yeah, it is. Yeah. Daniel Boone's just one tiny little sliver of the American story. And it's built on the backs of people like Daniel Boone, who just exhibited some just steel reserve. There's something about the guy. Now, I think he was a terrible husband. He was an even worse brother-in-law. But Daniel Boone, let's not kid ourselves. He was a badass. That guy had the grit that was necessary to kind of face the unknown. And that's what Americans are great for, even today. Like the entrepreneurs of today, these people that are pushing this AI frontier right now. I mean, there's a lot scary about that.
Yeah.
The people in Europe don't do anything, because they're afraid of that that's a different mentality altogether. They're afraid of the potential success and the uncertainty that could bring. I mean, there's a definite possibility that AI could sink the economy. It's not
and
zero.
Humanity.
Yeah, the possibility is not zero. Yet here we are, pedal to the metal. So, that spirit survives to this day. Granted, it's a little less bloody, which is a good thing.
Yeah.
But I don't know. The Americans, we certainly like to pick fights. Let's not get into that. But
we're going to get into that because in our news nowadays, we're still in. Supposedly, I'm not really sure that I even know what's going on with the war in Iran at this point. Is it over?
No, it is completely on. Last I read, in fact, here's the deal, man. There's no incentive for the U.S. to pull forces out until the IRGC is completely gone. I don't see why. I think right now it's just all political optics. So there was this memorandum of understanding, which is a ridiculous document. It's like let's all get together in Switzerland and agree that we're going to eventually agree. It's like, okay, that's kind of childish, don't you think? It's like you hit your brother. Can you apologize to him? No. Okay. Well, can you agree to eventually apologize to him? It's like, come on. Let's be real. Let's all be adults here. So. This memorandum of understanding apparently, happened. Did you see the videos of Shady Vance?
No.
He was just aghast, like, what's happening? It's all falling apart. It's almost like he was set up for the embarrassment of the whole thing falling between his fingers. I don't know. But sometimes I get the feeling that he's used as a patsy. I don't know if that's true or not. But you just kind of look at him. He just looks a bit confused at times. So anyway, the whole negotiation fell apart because Israel struck some place in, I think, Turkey. I can't recall. But it gave the Iranians the excuse to say, give them a casus belli, as they say.
Yeah, I mean, the long story short here is that the U.S. and Israel's allegiance, we're not as directionally aligned as we once were in this.
Yeah. So at least that's what we're being told. So, here's the deal, though. I don't know what's happening in the Middle East. I don't even think half the people in the know that are read in on this know what's happening. I just look at the incentives for what they are. The U.S. has a very, very strong incentive to police that area.
To have control.
Yeah, because it's all about the dollar. They want to make sure that all these important commodities go through the strait, are traded in dollars. So they're going through the U.S., dollar system. And as long as that incentive is there, I don't see how, the U.S. can just say, oh, forget about it. It's all under the bridge. We agree to, be peaceful and all that stuff. So anyway, I think we'll see this situation persist for probably the remainder of Trump's administration. So that's my take on it.
And ironically, oil is down at $70 a barrel.
Yeah. So put on the screen here, it's just, I think the market's just finally getting used to the taco trade, as they say. So, it peaked around, what was it, $113 a barrel. Today it's below 70. It's actually at $68.
So the war continues to rage on. Mm-hmm. Conflict's not resolved, but oil prices have come back under control.
Yeah, but did you see the administration's also accusing oil refineries of price gouging? So, which is like a play that you see anytime gas spikes, which is going to happen. You had some comments on this I wanted you to share. Anytime gas spikes, it takes time for that more expensive gasoline to go through the pumps and cycle through our cars and get burned up and all that. But, so we're still living on basically last month's fuel prices. So, and if you look at June prices were quite a bit higher. They were in the $90 range.
Yeah. Mm-hmm. Well, and I mean, my belief is that competition drives pricing lower, and so
I don't think that's a belief. That's a fact.
Yeah,
that's how it is.
So if you're a gas station and you sell gas for $4 a gallon, and the price that I'm paying for the gas goes down, why am I going to sell it for less than $4 a gallon? I can just make more money.
Exactly.
But that changes when there's somebody across the street that drops their price to $3.90 a gallon. So all of a sudden I have to figure out how to drop my price because otherwise I'm not going to sell as much gas. And that's where competition comes in and it makes pricing efficient. So I just think everybody raises prices together when the cost goes up because they all have to protect their margins. They can't lose money. But then as prices go down, it's just a much slower thing because they're not in a situation where they could lose money. They're in a situation where they might make more.
Yeah.
So it's just, I mean, this is what's the same thing that was going on with mortgage rates as long-term yields went down is like, why would a bank drop the rate they're going to give you on a mortgage just because rates have gone down until the competitive landscape makes it so that they need to?
Yes. So another news story I wanted to touch on. Did we talk about SpaceX? I know we mentioned it.
We spent the whole last episode on it.
Yeah. We were talking prior to we hit the record button that one of our most watched clips was about SpaceX and that the opportunity was probably in front if you still wanted in and not necessarily behind you. And sure enough, we pull up SpaceX, which here we go. It finally got pulled up. So the price. So far, granted, it just started trading on the 12th of June. So it peaked around, $225. Then it, of course, plummeted. So we went to the $150 trade range. I have some limit orders that triggered at $150.
Really?
So intraday, I know it went as low as $150 at least.
It's not an opinion. You don't endorse individual stocks, right?
No, I don't. Even at the 135 IPO, it's still so richly valued. I mean, the company doesn't make money. They're still in cash burn.
To me, this thing, I think I read something that the total amount of shares that are available to trade in this stock is like 5% of the total float. You have so many shares in this thing that are locked up for 6 months to a year. You have index flows that are going to come in. I mean, this thing is just going to move all over the place for the next little while as the dust settles. It doesn't have anything to do with the fundamentals here.
Nope.
Nothing.
Yep.
Right? It's just money moving effectively.
Yeah.
And I think we're going to continue to see volatility as all of that shakes out. But I do know there are a lot of millionaires created by that stock at the IPO. And, if any of my clients are in a spot where they've 100 or 200x their money and they have a 6 month to a year lockup right now, when that 6 months to a year is up, like we're buying the beach house.
Yes.
Yeah.
So, all right, last news story is regarding technology. So, we're seeing a lot of inflation, like price increases and things like MacBooks and video game consoles and computers. I was at Costco the other day, as I like to do, and noticed that there was a gaming computer. I'm with my boys, and they love looking at these games because they got the lights and the the LEDs and all that. And it was $3,700.
Yeah.
For a gaming computer. And my jaw just dropped. I was like, holy God, that's a lot of money for a video game console. And then this company, you've heard of the company called Steam?
Huh?
Okay. Steam came out with, it was going to be the PlayStation killer, this thing called the Steam Machine. So they finally came out with their own console. The sticker price on it was something like $1,200. Yeah. So it's a ridiculous price. But then you're also seeing, iPads are getting increased prices, iPhones, everything is increasing. And that's because of a lot of reasons. But one of the things that came up in the last couple of weeks is that there have been some lawsuits against companies like Micron, who is, you mentioned, was selling. Their sales did not increase at all. It was all price increases that padded their margins.
Well, what's happened is, I mean, this is an interesting shift because this is like AI trade 2026. I mean, for the first few years of AI, these were not the hot stocks. All of a sudden, we've realized that like the antiquated memory chips that are sold by Micron and some of these other companies, while they might not be the leading edge chips that are processing the AI, they serve as the memory for the AI. And so like I can't make this up. I mean, Micron stock year to date is up over 200%. If I go on a 1 year basis, Micron or hold on, give me 1 second here. Why is that? Oh, you know why? Because I'm looking at the memory ETF. Micron stock over the last 1 year.
I've got it pulled up on the screen here.
Up 838%.
Yeah.
Since this time last year. So it's 8x'd in a year. And what I'm hearing is that that's actually not on, like they're not actually selling more units. They're just selling the units for higher prices.
Yeah, and if you look, I pulled it up in Yahoo Finance, there's just a lot of blame going around. And actually there's lawsuits that Micron and Samsung are in cahoots.
SanDisk.
SanDisk? I thought it was Samsung.
Maybe
it was whoever but it was this and this other company. I thought it was Samsung, but I could be wrong. It might be SanDisk, where they control 90% of the DDR3, DDR4 market. And
no, Samsung. You're right. Samsung, Micron, and SK Hynix.
Yeah.
Hynix.
Yeah. So yeah, they're embroiled in lawsuits, or going to be at least, for price fixing. So apparently they all got together in a clubhouse somewhere and decided, you know what? Hey guys,
they all need us. They can't get around us.
And that's true. And they started, together, both of them increased their prices. So, and what we were commenting on earlier before we started was the fact that technology used to be a source of deflation in our lives. We were like, gas is up, milk is up, everything's up, home prices are up, but at least I can buy a flat screen TV for $500 now. It's like, well, those days are kind of gone now, aren't they? Yeah, so now everything, there's no relief from inflation, it seems. So it's concerning.
I mean, it's what is interesting is like everybody, when we started talking about this new inflation cycle earlier this year, everybody was really having that conversation because of oil prices. And now, like, oil prices have gone and come back, and we're still having the inflation conversation, but now it's not about oil prices, it's about chips.
What's trueflation at right now?
So regardless, the challenge is that AI is not deflating our expenses yet. So we'll have to see.
Trueflation, I don't think you can find it, but Trueflation says it's 1.75%. That just seems so low. I think it's higher than that.
Oh,
I don't buy that.
I think that kind of number will make people angry because we were just talking about it this morning out to eat. If you look at the price of food at a restaurant nowadays, it is crazy.
Oh my gosh, yeah. My son had a swim meet yesterday, and so they brought in some food trucks. It was a good time. Everybody liked it, but then the food truck was selling a smash burger, just a basic smash burger, nothing.
No sides.
Nothing special. Fries were separate cost.
Yeah.
The price of the smash burger was $15.
Yeah.
Which, mind you, I can afford that. But I'm not going to pay $15 for your stupid smash burger. Like, I know how much the ingredients cost. I'm not going to do that just out of principle. And then, by the way, that you pay $15 for the smash burger, they turn the screen so you can pay it, and the tip starts at 30%.
Yeah.
And then you got to go and do like the custom tip, and you got to do it while they're watching. I don't know about you. I might be an old curmudgeon now. I remember I used to be a server, and I would get from the Greatest Generation. This was a long time ago, two and a half decades ago. Now, I would serve, and they would leave me a quarter. And to them, that was a lot of money. But to me, I was like, it's cheapskate. But now I'm wondering, am I that guy now? Because I'm used to like 20% was a generous tip. You would do 12% if the service was kind of so-so. 15% was the standard, and then 20% was like, you really impressed me.
I always tip 20, but I've heard that it's there's all different ways. Sometimes people have said, well, tip 20, but don't include the drinks. Tip 20, but don't include the tax. I don't know. I just tip 20 on the whole balance. I tip 20.
What I do is I do the 10% and then multiply it by 2. That's all I do.
Just move the decimal.
And a lot of times to make it easy, I'll round it up so it's a round number at the end. So mathematically, it's just easy.
Yeah, just get it so it's an even dollar amount.
Yeah. So that's what I do. 20% to me, I think is good. I think that's generous. But now you're seeing these restaurants flip the screen on you, and you're seeing as high as I've seen 45%. So I'm like electively saying, yes, I would like to pay your salary. At what point is it the employer's responsibility to just pay their employee a fair wage?
Sure.
I don't necessarily agree with this whole tipping culture. And this is me coming from someone who I went through school, and paid for a lot of my housing through going through food service. I was a waiter for like 10 years. Well, not quite 10 years. It was like 6 years. So anyway, let's get off that topic and talk about episode 60, which is the 4% rule. So, for those of you who don't know, maybe you can what the 4% rule is. Maybe you can explain a little bit what it is.
Yeah. So the 4% rule, I teach the financial planning capstone class at the University of Cincinnati. And I have a case study, the first class. I get in there and I don't know. I don't know like the rule book for being a teacher. So I guess my first couple of years, I learned the first class you're not actually supposed to do any activity, but we did this activity anyway. So I pass out a fictional case study. It's a client in their 50s. They have saved a lot of money and they're very stressed about money. Mm-hmm. They want to retire sooner. One of the spouses is like unwilling to let the other spouse retire. And so I hand this case study out to all of the students and I break them into groups. I go around to each group and one of the fundamental questions I'm asking, well, really the most important question I ask them as I'm questioning is I say, well, do you think they can retire? And so I'll have, I generally have like 40 to 50 students. And let's say I break them up into 3 to 5 pieces. So we'll have 10 groups. I'll go around to the 10 groups and I'll say, do you think they can retire? And in this particular case study, the client has $5 million saved, and they think they spend $80,000 a year, but they don't track it. And the amount of students that tell me they need to budget mm-hmm. or they can't retire because they still have kids that are going to have to go through college. I get a lot of those answers, and so I've really used that first class as an opportunity to teach this rule, So the 4% rule was created in the 90s by a guy named Bill Bengen. He was an advisor and effectively wanted to be able to answer his clients' questions of how much money do you need to retire. And so he went and looked at the market over over the last 100 years or so, and he built a portfolio and stress tested it. How much could you pull out of the portfolio and still be okay, even in the worst decades of the stock market? And what he found was that the worst 30 years to be invested was 1968 to 1998. And in that 30 years, you started...
Pause real quick, because this data went all the way back to 1926, which included the Great Depression.
Yeah, so, we'll get to that a little bit later, but okay. The worst 30 years in the stock market for somebody living out of their money was actually not the 30 years that started with the Great Depression. It was the 30 years in the late 1960s going into the stagflation that we had in the 70s. And what he found is that in that 30-year period of time, you could withdraw about 4% of your portfolio per year, and at the end of 30 years, you would have had exactly $0 left, right? But it would have worked. Like you would have made it.
Yes.
Right? And so after he did that research, this rule became kind of like gospel in a lot of the financial planning communities. So like if you've heard...
It was published in the Journal of Financial Planning, I think in like 1993 or something like that.
And if you look at, like there are entire, if you've heard of the FIRE community, Financially Independent Retire Early, this is all kind of predicated on this 4% rule. You get to enough money and you spend low enough amount that they kind of equal 4%, and you just retire at 35 and coast the rest of your life. So this rule became really, really useful. Not... we do all sorts of financial, like fancy projections and blah, blah, blah. But in its simplest form, it's like, how much money do you have, and do you spend less than 4% of that? If you do, then you're probably going to be okay.
Yeah.
Right? And so anyway, 4% rule becomes pretty pervasive. And more recently, the same guy, Bill Bengen, went back and revisited his research. He said, well, when I had first done the research, it was showing 4%, but he had only used 2 asset classes. So when he had put together his fake portfolio to test this, he had used U.S. large cap stocks as the stock portion, and then and just treasury bonds as the bond portion. more recently, in the last couple of years, he wanted to do the research but not have just U.S. large cap stocks. He wanted to include international stocks and mid cap stocks and things like that. And then he diversified the bond sleeve. What he found by doing that was that actually the worst case withdrawal rate wasn't 4% anymore. It was like 4.7%. So there's this whole conversation now on like, what I think is ironic here is that if you go look at mainstream media, most of the articles that are going to mention 4% rule are going to say something like, is the 4% withdrawal rule dead?
Yeah, they like to see that, the word dead.
And like, I think 5 to 10 years ago, that kind of made sense to me because interest rates were nothing. I mean, bonds paid 1%. If a bond is paying you 1% and I want to withdraw 4%, like that's not great math.
Yeah.
Bonds are paying like 5% now.
Yeah.
I mean, I don't know. I think the 4% withdrawal mode maybe was close to dead. It died in 2022 and now it's back alive again.
Yeah.
You know, because 2022 bonds just got
died
absolutely
for 2
murked.
years. Yeah. Well, I do want to like segue real quick and comment on this. I pulled up the Barron's article where the worst year to retire wasn't 1929. It was actually 1968, which kind of it blew my mind when I read this because I thought 1929 would be a terrible time to retire. Stocks were down. How much were they down by? It was 80%.
Well, it was, yeah. So I'm reading I finished the 1929 book, and the first.
Here it is, right here. So we basically 1929, it was only down 8.4%. Then it was down 1930, 24.9, and then it was down 43.34. So collectively,
and then it was down again the next year, just not as much. So, yeah, I mean, look, I think you lost about 80% of your money at the bottom of the Depression.
It was brutal. Yet you were better off to retire here than in 1968, which really, you look at it, it's like, well, the S&P was really positive. So here's the thing, like Bill Bengen, and is it Bengen or Bengen? Bengen. Yeah, that's hard to say. Bengen. Bengen. So Bill Bengen built this study around a 60-40 portfolio. So that means 60% stocks, this stuff, 40% bonds. So it wasn't, in 1968, it wasn't the stocks that killed your portfolio. Everybody looks at the stocks as being, okay, yeah, the knife is in the hand of the stock market here. We all know who killed the victim. No, actually, it was bonds. I went back and looked at 1968. Look what happened in 1968. This is like when inflation started to spike up.
Yeah, it was inflation and bond yields.
And for those who don't know, bond yields and bond prices work inversely. So as bond yields go up, your old bond that you bought 2 years ago or 3 years ago with a subpar interest rate is now worth less. You have to sell it at a discount in order to get an equivalent yield to maturity. So what basically a rising yield environment murders your bonds. And that's exactly what happened. In 1968, you started to see over, 15 years almost? A little more, 17, about 15 years of rising interest rates, where it peaked in 1981 at around 15%. Yeah. So it wasn't the stock market. In fact, the stock market in 1968 was the only thing keeping your portfolio alive.
Yeah.
So I just wanted to point that out because I think a lot of people misunderstand how important stocks are to your portfolio.
Yeah, according to this Barron's article, that it was if you started with $100,000 right before the Great Depression, and they used a 4.66% withdrawal rate for whatever reason. If you withdrew 4.66% per year over 30 years, you actually ended with $105,000 at the end, 30 years after the Great Depression. So you ended with more money than you started with, even after living on the money through the Great Depression.
Yes.
Okay. And then in 1968, that didn't work. You actually ran the same 100,000 with the same withdrawal rate went to zero. So instead of replacing all of your money, you had no money left at the end of it. So I think that just, again, reiterates and reinforces why it's so important that we manage expectations with clients, because what takes you out in a bad market is getting nervous, freaking out, getting out, being over levered going into those situations. I mean, there were definitely people that went to zero, even though the stock market wasn't down to zero because of leverage.
Well, I personally don't know anybody who could withstand 4 years of this kind of return.
Brutal.
And not capitulate. I think every human alive that I know, at least, unless they're just not paying attention. some people just don't care. They don't pay attention. Would stay invested to get this whopping 54% return in 1933. But that's the way the maths. Go ahead.
So I guess kind of going back to what we were saying is the 4% withdrawal. So the 4% withdrawal rule is this back of the napkin rule that says how much do I need to retire, and you basically do the math on take how much you need to spend, divide that by 4%, aka multiply it by 25. That's the number you need. So if you spend $100,000 a year and you want to replace that $100,000 out of your portfolio, you need 25 times the $100,000, so $2.5 million. And in theory, you could take $100,000 out of that every year, and that money will last essentially through the worst 30-year periods of time that have been historically recorded.
Yeah.
The average, I think this is worth noting, the average safe withdrawal rate is 7. So if you just took any average 30-year period of time historically, you could actually withdraw closer to 7 or 8% and still have a perfectly successful retirement as opposed to 4. That is all to say that people say, is the 4% rule dead? I really argue the 4% rule can't. It's kind of based on the worst case.
Yes.
And that worst case was pretty dang bad.
Yeah. 15 years of 40% of your portfolio just, losing money. That's brutal.
So
wait, I wanted to show you this Reddit article real quick. So one thing that I do know, we've got there's a famous financial podcaster out there, a guy named Dave Ramsey, and he has. I've heard him on occasion suggest a 10% withdrawal rate. He kind of says it like, well, if your portfolio returns 10%, you should be able to withdraw 10%. So he didn't outright suggest 10% withdrawal rates, at least the clips that I listened to. But he consistently suggests 8% could be the withdrawal.
Because it's 10% and then 2% goes to inflation and then you take the other 8.
And this Dave Ramsey Reddit, it says deleted. I don't know what that means here. But
that just means the profile's gone.
Okay. It says, on yesterday's show, Dave told someone that if they had $600,000 life insurance policy, they can invest in a mutual fund, which will give them a 10% return. I inserted the word return, and they can withdraw $60,000 a year. So I've actually heard him say this. But most experts recommend a three's too low, to 4% withdrawal rate. So what gives here?
Yeah.
So let's talk about that. Let's talk about taking a withdrawal in excess of the average of 7%. So what's the risks of doing it? Why shouldn't you? The S&P 500, so if you just bought the S&P 500 the last 40 years, I think the S&P 500 the last 40 years,
about 10.5%.
It was like 11.4%, but it doesn't matter. It's over 10. So why can't you just take it?
Well, what happens is if you start, let's say you start with $1 million. And you're taking $40,000 a year, 4%. In theory, the $1 million earns 10% a year, $100,000, and so you're banking $60,000. But that's not how the market works in reality. The market goes up and down to get to that overall 10% rate of return. The last couple of years have been 20% returns, and in 2022, I think we were down 10 or 15%. So the actual number of years that are exactly up 10% is just not a lot. And what happens is if, let's say you retire with that $1 million, and let's say the first 5 years of retirement, the market's bad, and you lose 30% of your portfolio over the first 5 years. The market very well may average 10% over time, but you aren't the market. You have cash flows. They're coming out. And so what happens is, well, if you lose 30% on your $1 million, well, now you're pulling $40,000 a year on $700,000. And if you did that for 5 years, let's just do the math. You've got $1 million. I could probably plug this into something, but if you've got $1 million, and over 5 years, you pull out 40,000 times 5, so let's say $200,000. And on top of that, the portfolio loses 30%. You're probably looking at...
Well, let's chart it out. So, here I put the JP Morgan Guide to the Market. This is basically 30 years of the S&P 500. And, the first two, it's like a tale of 2 decades. You got one decade, which is commonly called the lost decade, and then you've got the banger decade, which has been, I think the last decade has been better than the 90s, honestly. But here's basically what you're suggesting. Here, let me...
And I can actually draw this up quickly if we can have a couple of minutes. Hold on.
Well, no, I'll show you right here. All right, so this is like the 2000 to 2010 market. All right. All right, so this is from point to point. We'll say average rate of return here is 8%. All right. All right, so let's start with $1 million.
So I charted this. I wish we could put this chart up here. Hang on. I got to add a zero.
Well, okay, let me just keep with my train of thought here. All right, so we start with $1 million, and you retire right here. So this is your retirement date, and you've got $1 million. And then let's say over the you need to take $80,000 a year. All right, and let's say this is a course of 2 years right here, and we've got a market of negative between here and there is negative 30%. All right, so by the time you get here, you've got $160,000 in withdrawals that you've taken out, and then on top of that, you've got about $300K in losses, and you're right here. All right, so now your portfolio is worth, so what is that? $460,000. Now you've got $540,000 of your $1 million left. And by the way, it still needs to produce $80,000. $80,000 in return. And if you just do the math on that, $80,000 divided by 540,000, that is a 15% withdrawal rate. So now in order just to tread water and not lose money,
you got to make 15% a year.
You have to make 15% per year. And by the way, that also doesn't include the effects of inflation. You just got murdered by what's called sequence of return risk. So what sequence of return risk means is just bad luck. You retired, but right as the market was about to nosedive.
Well, it kind of works. It has two sides, and this is why investing is so different, and you want different things depending on your situation. If I'm 35 years old and I'm in my peak savings years and I have durable income, I want the market to go down before it goes up. Right? Like I want my most productive earnings years where I'm saving to be the worst years because those years are going to have the highest future returns.
Yeah, you'd rather buy investments here than here.
The clients that I have that were in their peak earnings years from 2000 to 2010 are incredibly wealthy.
Yeah.
Because they were saving money while the stock market was down at incredibly depressed levels. So if you're in accumulation mode, and this is so hard for some of my 35 and 40-year-old clients to understand because, of course, they want to see their balance go up.
Yeah.
And I want them to see their balance go up. But the truth is, we know that over time, the market doesn't just go up in a straight line. It reverts to the mean. And so if we have really good years, then we'll probably have some not so great years. And knowing that we're going to get a bag of both, for my young clients, if I had to pick, I'd rather the bad years come now and the good years come later. That's a good sequence of return for the accumulator. But for the distributor, the person that's using their money, having the bad returns come before the good returns is bad because you rip to your example, you tear down the portfolio before it has a chance to pull up. In their situation, it's not that you don't want bad returns; you just want your good returns first. Yeah. You want your money to double before it gets cut in half.
Yeah,
right? As opposed to get cut in half before it doubles. And so this is a great example as to why the market moves all different times. You got to remember with the market, you have all sorts of different participants. Everybody has a different objective, different time frame, and they're all buying the same stuff. And this is why prices don't just magically find the exact right price level, is because everybody's buying and selling for different reasons and different circumstances with different time horizons. And so sequence of returns risk is the reason why, yes, the market averages 10.5% or whatever it is over time. And if inflation's 2.5%, then you can take the difference being 8, like Dave Ramsey would say. But if you take 8% going into a 5-year market downturn, you're not taking 8% over 30 years. Yeah. It's not happening. On average, you can take 8. So
what are your options? Let's say you take 8% and you're just like, market's not going to go. I'm going to take the risk. I'm going to take the sequence of return risk. And let's say it doesn't turn out in your favor. What do you do?
Well, I mean, the higher you want your withdrawal rate to be off of your portfolio, the more flexible you need to be with your spending. That's basically the bottom line. There are concepts. The 4% rule, when it was created, it was maybe a little generic. It's still a little generic, and so advisors have really worked to because we all want to tell clients they can use more of their money. I mean, from the advisor's perspective, you want to be able to tell a client, hey, take 5%, or what you want to take. The more they can take, the more money they can spend, and the more they can do in their life or whatever, right? In theory. So advisors have been working to how do we juice that withdrawal rate? And part of that is this new book from Bill Bengen talking about by being more diversified, you can take a little higher withdrawal rate. There's also a concept called retirement spending guardrails. And this has gotten pretty popular in the last 10 years. And it basically says that if you are willing to be flexible with your spending and not just take raises, then you can start at a higher amount. So they might actually suggest starting at a 5% withdrawal rate. But if the market goes down, you would adjust your withdrawal rate down. So there's a notable point. If you are committed and okay with the 4% withdrawal rule, the 4% withdrawal rule is designed to be a floor. You start at 4% of your $1 million, regardless what goes on with the market. You continue to withdraw the
way
original
Bill,
amount.
if I understand it correctly, the way he's designed it is that it resets every year. So essentially, there's a built-in inflation adjustment.
Only if it goes up, right? Because the 4% is designed that if the market goes down, you still take 4% of the starting number, right? So if you are willing to withdraw 4% of your portfolio based on the starting value today, the way that I would frame it to my clients is you may only ever get pay raises in retirement. Like there's a chance that you don't get a pay raise because the market does terrible and we just stick to this 4% and never adjust it. But the large majority of the scenarios are that the market goes up and we reset this 4% to 4% of a bigger number as time goes on. So they are getting pay raises in retirement. And some people only want pay raises. They don't ever want to be told in retirement that they need to cut back. And so if you don't want to have to cut back, start at a lower withdrawal rate number, because then you won't have to cut back. You've kind of hedged your need to cut back. On the other side, if you are willing to cut back from time to time, then you can start a little more aggressive. And so let's say you pull 5% of your portfolio out a year, and you have $2 million you start with, you pull 5% out, and a year later you've got $1.5 million. You may now reset that 4 or 5% to a lower number, and instead of taking 100,000 out, maybe take 70,000 out. And that flexibility allows you to preserve your portfolio through that downturn. So it's a little different for everybody, depending on how willing they are to be flexible with their spending and how capable they are to be flat. I mean, if you buy 5 houses and you've got mortgages out the wazoo, like reducing your expenses is kind of hard. On the other hand, if you're using the excess money to take a vacation, and it's a one and done thing, and you go on the vacation, the money's spent, you come home and the money's gone and you're not going on another vacation, like that's, next year if the market's down, maybe don't go on a vacation. Everybody has to determine, and this is why finance is so personal. When I say what's discretionary and what's optional, like, hey, how much money what are your essential expenses? Well, who's to tell me that it's my job to define what's essential for you? Maybe a $50,000 trip every year is essential in your mind. Maybe you, well, no, I guess my point is, like, what if you retired at 65 and you wanted to travel? Now the market's down. And so I look at you as your advisor. I say, well, that travel was optional. So now you're not going to travel because the market's down. Like, you're going to tell me to screw off. You wanted to travel. Why'd you retire if you couldn't travel? So is that discretionary or is that kind of needed? And I think this is where it becomes a little bit of an art to try to kind of figure out, like, what's the baseline amount of money that a client actually wants in a given year? Because, yeah, we could just pay them what it is to pay their mortgage and their heat bill and their electrical bill, but there are things that they want to do with their time in retirement that are important, that if they were cut out, while it's possible, they might not be as happy with the life they're living.
I generally find that people that I work with, they fall on one side of the spectrum or the other. They either want to take, or want would be a generous term. In their minds, they need to take a 10 to 12% income stream. So they're wanting to push the pedal to the metal, man. And then I've got the other client that they cannot stomach seeing their net worth decline in any way. So basically, they want to have a retirement nest egg that will inflation adjust, be worth the same amount of money or more by the time that they're dead. There's a small segment of the population, the FIRE people you mentioned. What's the acronym?
Financially independent, retire early.
Yeah. So these folks have an entire subreddit dedicated to them. And I say these folks, that sounded derisive.
We know some of these people.
Yeah, we do know some of these people. Great people. But they almost have a mental disorder where they cannot stomach seeing that their total nest egg decline. Like
I don't know if that's true, because the 4% withdrawal rule is based on a lot of volatility, right?
No, it's not. I'm generalizing.
Sure.
So yeah. So forgive me if I'm catching someone that's watching. They're like, "Well, I'm a fire person. I don't mind it." It's like, okay, there's exceptions, but I know these folks. I've dealt with them and I work with them, and they are so just driven to save that they cannot shut it off. They cannot, no matter what they do. It's like embedded in their.
You're not really talking about risk tolerance. You're talking about like, they're so good at saving and investing that like pulling their money out is hard.
Like for them to even withdraw 4%, it's like, whew, at most they'll take the dividends.
Well, we talk about this a lot. There's a lot of people that do a great job of saving and investing their entire life. And then they get to retirement and they've trained themselves so well to save and live within their means and invest that it's like, it's work to try to reverse that.
Well, yeah. And I don't mean to go down this tangent, but I just mentioned that because I find my clients are on one of those spectrums.
Yeah.
Very few, like a small subset are like, yeah, I'll do 4%. So you're probably listening to this thinking like, okay, well, 4%, do I need to plan for that? No, well, not necessarily. You might be lower than 4%. You might be higher than 4%. It really just depends on how flexible you are. Like you said, flexibility is the most important thing. If you're completely inflexible.
But it's not 9%. You're not taking 9% of your money. Even the best years, if we look at we've been talking a lot about the worst 30-year periods of time in the stock market. But if you look at even the best periods of time, you had maybe a little bit over a 10% withdrawal rate. So really.
Well, let me qualify your statement. It's not 9% indefinitely. There are folks out there that are happy to draw 9% for the first 10 years. And then they're like, well, in the last leg of my retirement, I'm happy just living off of Social Security. So, everybody's a little different.
Yeah, well, and it's actually a great point because, again, this rule is a little generic.
Yeah.
And one of the most important things there is like I have people retire all the time in their early 60s, and I tell them to delay Social Security until their 70s or until they're 70 or whatever. I mean, all else equal. And of course, there's extra money they're going to need to bridge that gap. It's not like, well, because you're delaying Social Security, let's live less. I'm taking what would have been their Social Security and paying it to them out of their portfolio. So the first few years are going to have a little higher withdrawal rate, but then the later years are going to have a lower withdrawal rate. And this is why you have a financial plan, because really mathing that out on the back of an envelope is a little challenging. But when we put this all into the software and we have earlier withdrawals, later withdrawals, Social Security that kicks in, pensions that kick in, home sales that kick in, whatever it is, it will tell you, in a little more detail than just the 4% rule, are you okay? But I think the 4% withdrawal rule is a great starting point. If you are 30, 40, 50 years old and you are thinking, I want to retire by a certain time period, and you have a rough idea of what you want your lifestyle to look like in today's dollars, you can pretty easily back into, well, what does that mean I need to have saved before I can jump ship?
In your mind, you just divide it by the exact 4% rule. Now is revised to 4.7, right?
Yeah. Now it's 4.7. Whatever. I mean, we can have arguments on the exact percentage. I mean, the bottom line is, let's say it's between 4 and 5%. What's a historically safe withdrawal rate? That would mean that you need 20 to 25 times your annual spending in your portfolio to just be done.
And it makes a lot of sense, because if you look at the average rate of return, I think JP Morgan has this, but I just give it up you off on the top of my head, of a 64 portfolio, it's somewhere around 8%, right? So if you let's just round it up to 5. Let's say you take 5% of that, and that leaves 3% return.
For inflation.
And then the next year you wash, rinse, and repeat.
Right.
So it just, intuitively makes sense to me.
Yeah.
That 5% should be the speed limit. And mind you, that is also around the average that a insurance company will provide you if you buy into one of these annuity products.
The math, all maths.
Yeah. So they say, the saying is, never pay poker with an actuary, right? Like, because they know the numbers and they've figured it out. They figured out how to give you a guaranteed income. That's what the word. That's the phrasing they use. A lot of advisors who sell annuities, they like using that term, guaranteed.
A personal pension.
Yeah. A personal pension. Yeah, that's the saying I've heard a lot too. In fact, I had a client. I'm going to go off topic here. Not on topic, but in a story. So I had a client that brought up to me in a meeting. He says, "Ben, tell me what you think about these private pensions. Should I set up a private pension fund?" And he's a business owner, so I'm thinking to myself, I've heard of
cash balance,
cash balance plans, stuff like that. I said,
plans.
yeah, but he has employees, so I was like, you can't really do that. Maybe there's like an executive deferred compensation plan, but it's a little bit different. That's not quite what you have in mind. And
turns out somebody's just slinging on an annuity.
And I said, it sounds like it could. I said, is it related to insurance? That was what I asked him. He says, well, I'm insured. I said, why don't you send me the proposals of the things? And it was just a freaking mess of insurance proposals, these things. And I sent him a dissertation back. Turns like, this is not good. That's not good. Right idea, wrong execution, that sort of thing. And he basically replied back, thanks for the research and all that. But anyway, these insurance products out there, most of them are gimmicky because they're designed to sell you something. But an annuity can be used. A lot of the annuities that you see that are plugged into like the 401k plans now, they're generally pretty well vetted because your 401k plan sponsor is acting somewhat as a fiduciary to have them in there. And there are advisory-based annuities you can go into that are recommended by fiduciaries. The key is you need to work with a fiduciary. But I digress. The main point I want to say is that these actuaries have figured out how much they can guarantee the annuity recipients before they start losing money. And that amount is around 5%. Now, there are instances where these companies start competing with one another, and they start to kind of increase that and they decrease it. But just in my experience, they average around that same amount.
And they might get a little, I guess this is probably more detail than we need on this podcast, but the shorter your time horizon, like this whole 4% withdrawal was built on 30-year time horizons. Mm-hmm. If you have 3 years to live, you can draw a heck of a lot more than 4% of your portfolio, right? So the point of saying that is that the smaller your time horizon, the higher your withdrawal rate could be. Like if we have a 90-year-old client that comes to me with $1 million, am I telling them that they need to withdraw 4% a year? No. Right, like, and so back to the annuity company, they may pay more than 5%, but normally that's because of your age.
Yeah, well, and it's also another thing that's worth mentioning too is that these actuaries, because they're pooling the risk, the odds of you living to 95 are a lot higher than the odds of a collective pool of 100,000 Brents living to 95.
Sure.
So the pool of 100,000 Brents is going to be much closer to the average, which is 77 or 83, something like that. I see all sorts of different.
Well, it depends. The average is dependent on your age.
But these insurance companies, they can basically pool risk and say, okay, we really only need to plan until withdrawals up until age 83 because some of our policyholders are going to win, a lot of them are going to lose. We just need to plan for that average. So that does allow some insurance companies a little bit more flexibility to increase the withdrawal rates, but that's also a source of profitability for them too. So let's not kid ourselves. These insurance companies are not altruistic. They're not just like, oh, since we can afford to give you a higher distribution rate, we're going to give it to you. It's like, no, they'll probably back pocket it.
The point is, when you give them money, they are giving you a guarantee in exchange because they believe that they're going to earn a lot more than what they're paying you.
Correct. And another thing to look out for, and I'll say this one thing and we'll be done with it, is a lot of these policies that are being sold are not inflation adjusted. So, they'll say, oh, you get a guaranteed 5%. Well, 5% of what? With Bill Bengen's formula, it was 4.7% of a watermarking increasing portfolio value.
It's inflation adjusted.
Yeah, it's inflation adjusted. So the 5%, well, what is it of? A fixed amount? Is it an inflation adjusted amount? Most of the time it's not.
Because if you put $1 million in something that's going to pay you $50,000 a year and 20 years from now it's still $50,000 a year, it is not actually $50,000 a year.
The two aren't the same. So you might say, oh, well, that deal's better because it pays me. Heck, I've even seen some policies that will pay 7%, but it's
level.
Yeah, they're level. So it's like, well, there's a break-even point. Yeah, it starts higher, but maybe in 5, 6, 7 years, the 4% or we'll
the
call it
4.7,
and you as a retiree, you want to account for inflation. Never assume that your expenses are going to be fixed. They are not.
The typical, the math says that prices double every 20 years. So if you retire for 30 years, prices are going to more than double while you're retired. And people forget about this a lot, but there are a lot of stories in the news about people getting priced out of their houses, people on fixed incomes getting priced out of their houses, priced out of all sorts of things. And the main reason for that is because they retired with a pension that was not inflation adjusted. And at one point, that pension covered everything. But now it's not 1 point anymore. We've had inflation, and turns out that even if you pay your mortgage off and you own your house, you still owe property taxes, you still have maintenance and upkeep, and all of those things increase in price every year. So inflation is a given, and you have to hedge it. So one last point I want to make, and this is just detailed. You talked a lot about bonds and all this, and everything we've been talking about today is based on like a 60-40 portfolio, 60% stocks, 40% bonds. You mentioned the bonds being the part that really hindered the portfolio performance in the 60s.
Yeah, right here.
I asked Bill, so recently as a part of Bill's kind of book tour, we had him do an interview with our local financial planning association here in Southwest Ohio. It was a Zoom electron, and I got to interview him. So I got to ask him questions. I specifically asked him, what did he think the impact would be of using more stocks or less stocks in his allocation? Because while his updated research uses a more diversified set of stocks and bonds, he still uses the same percentage of stocks and bonds. And he actually didn't test what happens if you increase the stock holdings or you decrease them. What he told me when I asked him what he thought, so I asked, what did he think the effect of owning more stocks would be on the withdrawal rate? He actually thinks the more aggressive your portfolio, the less bonds you own, the more stocks you own, the higher your sustainable withdrawal rate is.
Yes.
So, and I think that's really evidenced by your point around in the 60s and whatnot, the bonds being the part that got ripped. So he actually said to me, he thinks that the withdrawal rate would be higher the more stocks you own, but it then gets counterbalanced by the fact that you have somebody who's living out of their portfolio, and if they have too much volatility, they're less likely to stick with it. And so he actually kind of said, on one hand, you could have more money and live on more money by being more aggressive. On the other hand, that's a theoretical concept, and the market might go down and you could blow it all up.
Yeah, back to this, like, let's just look, let's rewind the clock a little bit and look at the S&P 500. There are multiple periods where the S&P 500 lost money for years. The Great Depression, 4 years in a row. We also had the 1940s, 3 years in a row. Then again in the 1960s, 2 years in a row here. Actually, the 60s, the stock market held up quite well, given all that was going on. Then we had the dot-com bubble bust. So realistically, like, we all love to buy stocks and invest in stocks, but I just don't think there's many people out there that can stomach more than 2 years of loss. I remember in 2022, this was this mark right here. I called this the year of death by 1,000 cuts, because the year started out and then it was just a little bit lower. We didn't have like one massive sell-off in 2022. It was just like constant.
It was a whole year.
It was a whole year of constant
discouragement. We peaked on January 1st of 2022.
And it was just
malaise. We didn't bottom until October, end of October.
And I don't know, I didn't have any clients capitulate at the time, but they were very uneasy. And I can remember the dissatisfaction, even though the drawdown, the return was just negative 18.11. I had more angry is not the right word, like nervous clients during this time than I had during the face-ripping sell-off of 2020 at 30%. Remember, from January to March, we had 30%. By the way, we were back to positive 30 days from March 31st.
Yeah, every sell-off we've had outside of 2022 in the last 6 years has been a month, maybe 2 months.
So in my experience, I completely agree with Bill that the average human being cannot stay 100% invested in stocks just because they just don't like losing money for a period longer than a year.
But what we're here to tell you is that by taking a small enough withdrawal rate and, again, controlling the things you can control. You can't control what the market is going to do this year or next. You can control how much of your money you're going to use of it. And by taking a small enough amount, 4.8%, 4.7%, whatever it is, you can put yourself in a position where, while it may be tough to hang on through 2 or 3 years of downturn, you are set up to survive, right? And my hope with a lot of the clients we work with is that by planning and reinforcing that concept and having that conversation over and over and over again, when the time actually comes for them to kind of put their money where their mouth is and stick with it, I sound like a broken record. And that's what I always tell people. Like if you call me in the middle of a downturn and I say the same thing I've been saying for years and I sound like a broken record, that's a good thing. Which scenario makes you more comfortable? If you call your advisor during market volatility and he says, all these principles we've based everything on for decades are still intact and we're going to go with that. Or if it's like, hey, let's throw out everything that I've ever talked about and all of a sudden let's change course because, you're right, this time is different. I mean, I should sound like a broken record when those things happen, right? Because if I don't, that means I probably wasn't saying enough while the market was doing well.
Yeah, that's right. Great way to cap that off. All right, so we got a tip of the day.
Do we?
Yeah. So we talked about it, and then we forgot it. We're terrible at getting the tips. So last week it was consumer reports. So there was a great time to buy. Apparently we wanted to buy heart rate monitors. That was the
I thought that was so cool that the consumer reports had like a calendar and told you what stuff.
You know what we should do is bring up consumer reports and see like this month what was the right thing to buy. Let me do that while you look up the tip of the day.
Well, I've already got it here. I mean, I was just joking.
Go ahead. Yeah, take it away.
The tip of the day or the week or whatever, use the tip how you want, is that every state has a different website department for unclaimed funds.
Yeah.
So if you've ever had money lingering out there that you overpaid somebody, they readjust a bill and they didn't know how to get it back to you, these funds effectively just get sheeted to the state. It's called a sheeting to the state. And there's an account that the state has that kind of keeps track of all of this money. And you can go to this website and you can put your information in and it'll search and see if you have any unclaimed funds. And most people do.
Yeah, I put up the screen. On the screen, we've got the Ohio, because that's where we're at. We live in Ohio. And every state will have its own. Ohio, yeah. Does it sound like what?
I feel like when I moved here from North Carolina, I thought everybody talked like they had their nose shut. Now I'm that person.
Yeah, you're that person. All right, so you just basically go in, and I did this for a client recently, and we found like $1,000. Yeah.
So, I mean, it's. I have had more times where we found money than not found money doing this.
Yeah, so you should. Everybody should go in there, especially if you've changed jobs several times. You might have a retirement plan, and this is usually what happens. Like someone's like, I kind of vaguely remember having a retirement plan with such and such company. It's like, well, if you did, it should show up here.
Yeah. Yeah, there's all sorts of stuff that shows up in here. I've seen it be as little as a couple bucks. Like you said, you had $1,000. I think the likelihood that you're going to find $100,000 is pretty low. But you might find some extra money that's been lingering out there. It's probably worth the 5 or 10 minutes.
And just to, maybe we should make this a segment, but best time to buy, according to Consumer Reports, blood and glucose meters, blood pressure monitors. So if you're concerned about your blood work, now's the time to buy those.
I wonder why.
Yeah.
It's like a weird category to be the way to go this month.
My guess is this is a good time to buy this stuff because a lot of people are not focusing on it because they're usually
they've given up on their New Year's resolutions.
Well, my thinking is that everybody kind of pursues their health care at the year end because they're trying to like cap out their policies.
Yeah.
So I don't know.
So we're in no man's land as far as health care.
Clothes dryers, not washers. Well, yeah, no washers, just clothes dryers. So dryers only, y'all.
Interesting.
Dehumidifiers, dishwashers, grills, insect repellents, home security cameras, microwave ovens, steam irons, sunscreen, strollers, refrigerators, and washing machines is there. It's
why they put it down at the bottom.
So if you need a new washer dryer, according to Consumer Reports, now's the time to buy. So,
before all the DRAM chips send the prices higher.
That's right. Well, for everybody who stayed this long, really appreciate you joining us on this episode 60, the Money Alchemist podcast. Happy bicentennial, 250th. Everybody have a safe and wonderful time, and we'll see you next time.
Opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly. Investing involves risks, including the potential loss of principal. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision. Advisory services offered through National Wealth Management Group, LLC.